Good morning, doctor. My name is Peggy. Today, I'd like to give a brief overview of the multinational corporation that's chosen by our group, which is McDonald. McDonald is one of the biggest and most well-known fast food company, and there is a total of 40,275 restaurants worldwide. Besides that, McDonald operates in 118 countries and serves over 69 million people daily. McDonald earns 23.18 billion in global revenue in 2022. In Malaysia, McDonald operates more than 320 locations around the world, serving over 13.5 million customers a month. McDonald set its first branch in Malaysia on Jalan Bukit Bintang, Kuala Lumpur in 1982. Besides that, McDonald's main menu items are hamburgers, cheeseburger, chicken nuggets, and fries that are accessible in each country. As Malaysia is a Muslim country, McDonald offers halal food and also launched Nasi Lemak McD that suit local tastes. Approximately 93% of the McDonald restaurants are independent franchise, which is decentralized, as the parent company allows its subsidiary to make their own decision, but there are also McDonald restaurants that undergo centralized. McDonald is currently working hard to increase its market share in developing countries that have bright futures. For example, to serve customers both online and offline, McDonald is making significant investment in digitalization initiatives, including delivery service, self-order, and also smartphone ordering. Next, McDonald is implementing new technologies such as automated drive-thru and kitchen automation to reduce their expenses and boost their productivity. Besides that, there are also challenges and opportunities faced by McDonald's, which are competition such as Kentucky Fried Chicken and Burger King, changing customer preference to more sustainable and healthier food options, and the labor market. Lastly, McDonald is continuously searching for new markets to enter and expand. For instance, McDonald is planning to open roughly 10,000 restaurants worldwide by 2027, making the fast food chain fastest expansion phase ever. Thank you, that's all from me.
Now, I will talk about the exchange rate risk. Exchange rate risk, also known as foreign exchange risk, refer to possible financial implications that arise from fluctuations in currency rates. Due to growing globalization, the exchange rate has emerged as an important concern for companies functioning in international environments. The first exchange rate risk is economic conditions. McDonald might face exchange rate risk when the economic conditions change. Inflation is a significant economic condition that can greatly influence the exchange rate and, as a result, have a considerable effect on multinational companies. When one country faces inflation, it will affect its purchasing power parity. If inflation happens, McDonald may face increases in costs if it purchases products and supplies from local resources or import them as a result of inflation in the local currency. To maintain the company's profit margin, McDonald might have to increase pricing of its goods and service in certain countries, which might affect sales volume and consumer purchasing power. Second is political stability. Stable governments are more likely to implement efficient economic policy, resulting in greater economic resilience and a stronger currency. As I mentioned, political stability could affect the multinational companies' operations. For example, the unstable politics between Russia and Ukraine caused McDonald's to pull out from Russia after a presence of over 30 years due to the ongoing war in Ukraine. McDonald's declared on May 16 that the temporary shutdown of its restaurant in Russia would be transformed into a permanent closure. Due to the humanitarian crisis resulting from the war in Ukraine and the unpredictable operating conditions, McDonald's has decided that it's no longer feasible to own the business in Russia. The currency trend is another exchange rate risk that multinational companies will be faced. Fluctuations in exchange rate can affect the reported revenue of a multinational company when it is converted back into the company's domestic currency. For instance, when McDonald's offers a hamburger in Japan, it accepts Japanese yen as payment for the burger. When the corporation returns the proceeds, it is required to convert the yen into dollar. When the dollar appreciates against the yen, McDonald's faces a loss in the revenue it generates from selling the hamburger when it converts the currency due to the dollar's appreciation against the yen. The exchange rate now requires a greater amount of yen to be equivalent to $1 compared to the previous rate. So, these are the exchange rate risks that the multinational companies could face. Can Jasmine you suggest us some solution to minimize this exchange rate risk?
Yes, Yuki, there are some hedging strategies to minimize this exchange rate risk. To deal with the exchange rate risk of economic condition, McDonald adopts a flexible strategy for forward contract, adapting their value and duration according to the current and anticipated economic conditions. This adaptability allows them to modify the contract volume and duration to hedge effectively during the changing economic circumstances. For instance, in a smaller emerging market like Malaysia, where the volatility is higher due to the factor like commodity prices and currency fluctuation. A dynamic forward contracting is more crucial to secure a favorable exchange rate, guard against the currency devaluation, and estimate the cost accurately. While the dynamic forward contracting offers advantages such as securing fixed currency rates and a reliable cost estimation, and it has drawbacks. One of the significant disadvantages is the opportunity cost, where committing to a specific currency rate may prevent benefiting from favorable rate fluctuations. Additionally, securing unfavorable rates during the substantial currency strengthening can lead to increased expenses during the currency conversion. To deal with the geopolitical stability, McDonald conducts a comprehensive geopolitical risk analysis to assess the political stability of the nation in which they operate. This analysis helps to identify the potential challenges and allow McDonald to make a strategic decision in alignment with the current political environment. However, geopolitical analysis is complex, subject to rapid fluctuations, and may not foresee all the development or unexpected political risks. McDonald, as a global MNC, evaluates its currency risk based on its exposure to the foreign currency. They may implement the strategy currency swaps to mitigate the unfavorable currency fluctuations. Currency swaps can reduce the transaction cost compared to other hedging instruments. Still, they involve the counterparties, necessitating thorough evaluation of their financial stability to minimize the risk. In conclusion, McDonald employs a multifaceted approach to currency risk management, considering the economic condition, political stability, and currency trends. This approach enables the McDonald to navigate the complexity of the global marketplace and safeguard its financial interests effectively. So, what is the next?
Now, McDonald's being an MNC is exposed to a wide variety of risks affecting its subsidiaries and its operation. One such risk is transaction risk, where the financial transaction is being affected by the instability of the exchange rate, which can be due to political risk and political instability. One such example is the Ukraine and Russia war. Now, during this war, both countries are focusing and putting their money and their focus on the politics rather than the economy. Now, because of that, it caused a depreciation of currency in, for example, Russia. Now, this also increased the cost of transactions within those countries and the cost of running the operations. Besides that, the political instability also caused McDonald's to shut down 850 of its chains in Russia, making its exit from the country in total, losing a large amount of customer base and income. However, it's profitable on their side. Now, the second risk is about changing in government regulations. Oftentimes, when MNCs are exposed to exchange rate risk, they mitigate it by undergoing certain mitigation plans. Right? For example, they try to curb from currency depreciation by exchanging into a more stable currency when it comes to the income. Oftentimes, government regulations that prevent this from happening will oftentimes enable the MNC to not offset a lot of the exchange rate fluctuations that happen, and this is imposing a very high cost to the MNC because depreciation of currency meaning they lose value in their income, and this depletes their financial performance as a whole. Now, thirdly, it's also about the tax. If the tax level of a particular country is high, that means the financial performance of the country or the financial health of the MNC as a whole also depletes because costs are rising. Now, let's also talk about the next risk, which is like translation risk. This is where a depreciating currency will cause the MNC to record assets and other financial component into a much lesser value. This means that now the MNC's value is just decreasing when the currency is depreciating. And like I said before, if regulations prevent them from mitigating this risk, eventually it causes the MNC a wide variety of harms which are unable to be mitigated as they're different for every country, for every currency that they exist in and operate in. Now, another important risk is economic risk. Like I've mentioned before, if McDonald's is operating in over 100 countries, oftentimes they are exposed to 100 different economies out there. There might be growth in some, there might be like sedentary in some, and there might be like a decline of growth in some. Now, the inability for them to be able to curb inflation, or the inability for the governments to curb inflation, can eventually have an adverse effect on the MNC, because now their cost of producing and operating just got way higher and they need to lay off employees to cut costs, which is not a good look for the MNC, and it's a big burden for the operations as well. Finally, it's the inability for them to sustainably operate in the long run, and this comes as an exchange rate risk as a whole, because eventually when they're exposed to different currencies and different risks, they're unable to properly calculate what their future health or future financial health will look like. This can be very harmful to MNC, because now they cannot foresee what's happening. This will eventually give them financial problems, which will reduce their ability to expand further, or even be very cautious in the expansion, because now the cost of import will be higher and this will increase the cost of goods sold, and further this may even decrease their profit. And all this happens when the currency of the importer appreciates, and vice versa, the currency of the MNC operating in a particular country depreciates, as this is very high risk that the MNC faces in almost every country it operates. Now, last but not least, it's also very important to understand that McDonald's in these countries with high volatility, like for example Mexico, Turkey, Argentina, are at greater risk of this economic risk in comparison to much more stable economies like the US and the UK. The reason why is because these countries do not have very sustainable or increasing demand. At the same time, they operate within a certain level of risk, and their government policies and economic policies do not cater to the growth of the MNC as a whole. Therefore, these risks are all going against MNC's long-term goals and the objective to expand and increase its value.
First recommendation that we want to make is to buy and have political risk insurance. Therefore, they can be protected by changing political events that are negatively affecting profits and revenue. The MNC can have financial protection on its assets, freedom on trade, and profitability. This insurance and support are given by the International Monetary Fund and World Bank, who will then be obligated to protect the MNC. Another recommendation is that McDonald's can engage in lobbying and developing relationships with governments that house the most franchises to ensure the policies enacted do not severely hurt them. This can protect them from several policies such as foreign exchange control and multiple decisions taken during economic turbulence. McDonald's should consider adopting currency swap in addition to forward contracts. McDonald's can lessen the risk associated with fluctuation in a certain currency by using this strategy, especially in places where it is significantly exposed. Through currency swaps, McDonald's can get foreign loan at lower interest rate than it might from borrowing directly in overseas market, or utilize them to offset the transaction risk associated with existing international loan. Then, for the adjustment of capital structure, rising local currency finance in the nations where it operates should be an option for McDonald's to further reduce exchange rate risk. McDonald's can mitigate the effect of currency change on its cash flow by aligning its debt obligation and income by issuing debt in the local currency or foreign currency that are more stable. Furthermore, McDonald's should contemplate hedging its capital structure by investing in foreign currency bonds. Investing in foreign currency bonds has the potential for higher return. This might provide McDonald's access to an extra revenue stream. It also mitigate the interest rate risk that arise, as now MNC can actively choose to engage in countries that can benefit them the most.
Hi and hello everyone, I am Rachel and I'm here to assist you with the capital structure of the McDonald, or famously known as McD. So, after winning and out from the McDonald or order the McDonald meals and drinks from the drive-thru, have you ever wondered how does the McDonald manage to keep grow and expand over the time? So, I guess you might still have doubt, but no worries, I will share it with you. It is related on how the McDonald manage its capital structure. But wait, hold on. What is capital structure? So, before we get started, let me briefly explain to you that the capital structure is actually the specific mix of debt and equity that it is used to fund the firm's overall operations and expansions. So, as we all know from previously, McDonald is actually an MNC, hence aligning with the main objective of MNC, which is focusing on maximizing the shareholder wealth, makes McDonald need to have an optimal capital structure to shape its global expansion plans. An MNC operating in international markets face currency exchange risks, debt financing, equity financing, currency hedging, and lastly, diversifications. Then, do you know that the capital structure between McDonald parent company and its daughter companies across the different countries has various capital structure based on the differences in the country, such as the economic rules and regulations and the fluctuating exchange rate. To portray, McDonald's in the United States US might have access to reputable and liquid debt markets in the US as McDonald's is listed in the New York Exchange stock. And this means McDonald's in US have a mixture of its debt and equity. Meanwhile, McDonald's capital structure in Malaysia is 100% on equity and it was acquired in 2017 by Reza Group companies from Saudi Arabia. But McDonald's in Malaysia is not listed in the Bursa Malaysia. So here's a fun fact about MNC. MNC can have its management in terms of centralized or decentralized. So to sum up, in the capital structure of multinational companies, a careful balance must be struck between debt and equity, as it is vital for maintaining the financial health and helping to achieve the world growth objectives in the longer term, thus maximizing the shareholder wealth aligned with the main objective of MNC.
Conclusion, McDonald exchange rate risk is a key concern. Economic condition, political stability, and currency movements can all affect the exchange rate analysis. Besides that, transaction risk, risk of foreign exchange control, translation risk, economic risk, risk of sustainability, and interest rate risk are key risks of an exchange rate. However, McDonald employs several techniques including forward contract, buying and having political risk insurance, engaging in lobbying and developing relationship with the government, currency swap and diversification to mitigate exchange rate risk. While for the adjustment of capital structure action, such as rising local currency finance, controlling and managing foreign investment, and investing in foreign currency bond are crucial to reduce exchange rate risk. Overall, McDonald can continue to grow its international business and effectively and also efficiently manage foreign trade risk by putting this suggestion into practice.